Have you ever wondered why some people seem to thrive financially during a recession, while others struggle? This is the paradox of wealth creation during a recession. It is a fascinating phenomenon that has been observed time and time again throughout history. Let's delve into this paradox. When the economy takes a downturn, most people's instinctive reaction is to tighten their belts, to hold on to their money with a vice-like grip. They see the falling prices and the red ink spreading across the stock market, and they panic. But there's a select group of individuals who see things differently. They see not a crisis, but an opportunity. This is where the concept of contrarian investing comes into play. Contrarian investors go against the grain. They zig when everyone else zags. They buy when everyone else is selling. They are the calm amid the storm, the ones who see the silver lining in the darkest of clouds. The principle behind contrarian investing is simple, yet profound. Buy low, sell high. It is the fundamental tenet of investing, yet it is so often overlooked, especially during times of economic crisis. When the market is in freefall, prices are low. And when prices are low, it's the perfect time to buy. But this isn't just about buying any old stocks. It's about identifying those quality companies that have been unfairly beaten down by the market and scooping them up at bargain prices. It's about seeing past the short-term fear and panic and focusing on the long-term potential. So, while the majority of people are panicking and selling their stocks, these savvy investors are calmly stepping in and buying. They are using the recession as an opportunity to increase their wealth. When the market eventually recovers, as it always does, they are the ones who reap the benefits. This is the paradox of wealth creation during a recession. It's not about luck or timing, it's about strategy and perspective. It's about understanding the cyclical nature of the economy and using it to your advantage. So the question is, how can you join the ranks of these recession-proof investors? To start off, you need to understand the basics of a recession and investing. Let's take a quick stroll down economics avenue. A recession is a period of temporary economic decline, typically characterized by a fall in GDP in 2 successive quarters. It's like a big gray rain cloud hovering over the economy. Businesses struggle, unemployment rises, and overall economic activity slows down. But you see, every cloud has a silver lining. Recessions can also present unique opportunities, especially for informed investors. Think of it as a sale at your favorite store. Everything's marked down. Stocks, real estate, commodities. They all tend to be on sale during a recession. That's where the basics of investing come into play. Investing at its core is about buying assets with the expectation that they will increase in value over time. It's like planting an apple seed today, nurturing it, and then enjoying the fruits of your labor later. But just like any venture, investing comes with its fair share of risks. The apple tree might not grow, or it might take longer than expected to bear fruit. That's where the concept of risk and reward comes in. Higher risk investments usually offer the potential for higher returns, but they also come with a greater chance of loss. On the other hand, lower risk investments generally offer lower returns, but are less likely to result in a loss. The key is to find the right balance for you. In the world of investing, knowledge truly is power. Financial education is crucial. It helps you understand market trends, interpret financial news, and make informed decisions. It's your compass in the often turbulent seas of the market. Staying informed about the global economic landscape and local market conditions is equally important. It's like checking the weather forecast before stepping out. It helps you prepare for what's ahead. Now that we've covered the basics, let's dive into the strategy. The first part of the strategy is to buy low. A recession, while it may seem like a time of financial doom and gloom, often presents us with a silver lining: undervalued assets. In the midst of a recession, the market is in a state of panic, as investors are selling off their assets. This creates a situation where the price of many assets, such as stocks, real estate, and commodities, drops significantly. It's like a sale in a shopping mall, but instead of clothes and electronics, it's assets we're talking about. Now the trick is to identify these undervalued opportunities. It's not about buying anything and everything that's cheap. It's about finding assets that are cheap for no good reason. This requires a keen eye and a deep understanding of the market. Look for assets with strong fundamentals, a robust business model, a solid track record, a competent management team that are currently out of favor in the market. Of course, spotting these opportunities is easier said than done. It requires a considerable amount of research. You need to dig into the financials of the companies you're interested in, understand their business model and industry, and keep up to date with the latest news and developments. It's a bit like being a detective piecing together bits of information to form a complete picture. But it's not just about research. It's also about having the patience and discipline to wait for the right opportunity. Remember, the goal is not to buy when prices are low, but when prices are lower than they should be. That's when you get true value. And finally, it's about having the courage to go against the crowd. In a recession, the common sentiment is fear. It takes guts to stand against this tide of negativity and take a contrarian approach. But as the saying goes, fortune favors the brave. But remember, buying low is just the first part of the strategy. Now let's move on to the next part, selling high. The second part of the strategy is to sell high. Selling high is the other half of the equation, the yang to the yin of buying low. But how can you tell when an asset's value has peaked? That's the golden question, isn't it? Well, there's no crystal ball to predict with absolute certainty. However, by keeping a close eye on market trends, economic indicators, and company performance, you can make a pretty educated guess. Let's first talk about market trends. These are patterns or tendencies in the financial markets. If you notice that an asset's price has been steadily climbing for a while, it might be reaching its peak. But be careful not to jump the gun. Sometimes, what looks like a peak is just a temporary plateau before the asset continues its upward trajectory. This is where economic indicators come in. These are statistics about economic activities that can help you understand where the economy is heading. If the indicators suggest that the economy is slowing down or entering a recession, it might be a good time to sell your assets before their value starts to drop. Then there's company performance. If you've invested in stocks, keeping track of the company's financial health is crucial. If the company starts underperforming, or if there are changes in leadership or strategy that you don't agree with, it might be time to sell. But perhaps the most important thing to remember when it comes to selling high is this: don't let emotions dictate your decisions. It's easy to get caught up in the euphoria of a booming market and hold on to your assets for too long, hoping that their value will keep going up. But greed can be your downfall. Remember, the goal is to sell high, not highest. It's also essential to be patient. The market can be unpredictable, and sometimes it takes longer than expected for an asset's value to peak. Don't rush to sell just because you're not seeing immediate results. Patience, as they say, is a virtue. Selling high might sound simple, but it requires discipline and patience. One key aspect to remember while investing during a recession is diversification. But what does that mean? Picture a tightrope walker. If he's only balancing on one rope, any gust of wind could send him tumbling. But if he spreads his weight across multiple ropes, he's far less likely to fall. Investments work in a similar way. During a recession, some sectors may be hit harder than others. If all your eggs are in one basket, so to speak, you're vulnerable to significant losses. Diversifying your investments across various sectors and asset types can spread out this risk. This can help protect your portfolio against the volatility and uncertainty that often come with a recession. Think of it as not putting all your faith in one tightrope. Instead, you're spreading your balance across multiple ropes, making you more resilient to the winds of economic change. Diversification can be your safety net during a recession. The information provided in this video or communication is for informational and educational purposes only. It is not intended as and should not be considered financial, investment, legal, or tax advice. The content is based on general principles and may not be applicable to your specific financial situation or needs. Always consult with a qualified financial advisor, accountant, attorney, or other professional before making any financial decisions or taking any actions related to your finances. Any investments or financial decisions you make are solely your responsibility. Past performance is not indicative of future results, and there are no guarantees of any specific outcomes or returns. While every effort has been made to ensure the accuracy and completeness of the information provided, we do not warrant or guarantee its accuracy, reliability, or suitability for your individual circumstances. We do not endorse or promote any specific investment products, services, or strategies mentioned in this video or communication. Any references to such products, services, or strategies are for illustrative purposes only, and do not constitute a recommendation or endorsement. You should conduct your own research and due diligence before making any financial decisions. In summary, this video or communication is not financial advice, and you should not rely on it as such. It is essential to seek professional advice tailored to your specific financial situation and goals before making any financial decisions or taking any actions.